I recently came across this Japanese phrase in a book, ichi go ichi e, which means we could do this event again in 1 year, but we have to praise this event for what it is, because we'll be different people with new experiences and knowledge in a year. At this point in our lives, most of us are young adults who are maybe starting their career or looking to start their career, who have at the back of their minds thoughts about building a family, moving out, caring for our parents as they become older, etc. So our current perspectives and thoughts may be different than a group of older adults who are attending a tax event. They may have a house already, have children who are leaving the nest, and are getting ready to retire. So thank you everyone for making each spread event, Ichi-go, Ichi-e, special and memorable. And welcome to Spread Event 31, Itemized Deductions with Anna. I know it's not the most exciting topic to discuss on a Saturday morning or for any morning, but we believe that everyone should be familiar with the basics of financial management, including savings, investment, retirement, and taxes, so we can all have a foundation to build wealth and become financially independent. If you didn't know, Anna passed her CPA exam recently. The exam is one of the most difficult professional credentialing exams, with pass rates hovering around 50%. So many people have to retake the test. So it's fantastic to hear that Anna passed it and can do all of our taxes now. Today, she'll be reviewing itemized deductions with us. Most of us are probably using standardized deductions when filing taxes, but reviewing the different methods will be helpful when we start earning more money and get rich, so we can minimize how much we pay in taxes, aka the tax burden. With that, please welcome Anna and feel free to ply her with all of your questions.
Good morning, everyone. Thank you for joining me this morning for Spread. My name's Anna, and some of you may have listened in on my previous presentation on overview of federal income taxes. Today, we'll be discussing itemized deductions. And as a reminder, federal and California tax returns are due April 15th, which gives us a few more weeks. And for those who don't think that they're going to make that deadline, I would recommend you to look into extending the tax returns. But keep in mind, if you owe any taxes, you need to pay them now. And keep in mind that I'm only sharing what I know. I may or may not be 100% correct, so feel free to discuss in the Q&A if you have any points you'd like to bring up. We can all discuss and share knowledge. And before we go into the presentation, I want to get to know everybody a little more, if I didn't already know you already, and participate in a little icebreaker so I can kind of gauge who my audience is. And I'll also be opening up Q&A right now. So if you have any questions during the presentation, feel free to go to this link, and it's going to be on the presentation on top. So feel free to go to the link whenever and put down any questions you have, and I'll do my best to answer, and we can all share our knowledge. Okay, so let's hop into the icebreaker. So the link is going to be in the chat. Go ahead and click that link, and we're going to be here in the warm up. Let me open it up for voting. And the first question, I'll give everyone a little bit of time, so I'll read this. Did you attend the previous income tax presentations? So if you guys were in the previous presentation and you remember the overview of income taxes, you should know that this is the tax formula. And it's somewhat lengthy, but it's critical to understand it because it's essentially what the tax form asks you to do. It's the backbone of calculating your income taxes. Even though there's a lot of subsections, a lot of forms you have to fill out, this is essentially what the IRS does to calculate your taxes, and what your tax preparer would also do as well. So let's start from the beginning. Gross income. It's money you make. This includes anything on your wages, from interest, dividends, retirements, things like that. And the IRS actually understands that income taxes are a financial burden and offers ways for taxpayers in certain circumstances to save in taxes. And the first way to save is through adjustments to income. Adjustments to income can bring down your gross income or bring up your gross income, depending on the item, and it's filed on Schedule 1. Adjustment savings include educator expenses if you're an educator, the traditional IRA deduction if you contributed, student loan interest deductions, and in 2020, there was also the unemployment compensation exclusions. So normally in California, unemployment payments are not taxed for California, but they are taxed at the federal level. In 2020, since a lot of people were affected by the pandemic and didn't have a job and claimed unemployment benefits, a certain portion was excluded from income. So if you didn't do this in 2020, I suggest you look into it. And these adjustments to income are also called above the line deductions, with the line being adjusted gross income. And it's the short name for this is AGI. You probably hear this a lot, AGI or MAGI. And it's an important term and number because it's the benchmark used to determine whether you qualify for all the different tax credits and benefits and how much of it you qualify for. So it's really, really important to lower your AGI as much as possible. And you'll see later in this presentation how it affects your itemized deductions as well. Next is the below the line deduction, which is what we are going to be talking about today. So the below the line deduction, remember the line is AGI, includes standard and itemized deductions. Once you subtract that from your AGI, you get your taxable income. And taxable income is the amount the IRS taxes you on. So they can either multiply your effective tax rate to your taxable income, or they use a tax table to look up how much tax you owe based on your taxable income. And that gives you your tax liability. Tax liability is how much the IRS expects you to give them in taxes throughout the year that the tax return is covering. So this year we're doing 2021 taxes. Your tax liability for 2021 is how much taxes you should have paid all of last year. And this includes, things they took out of your paycheck or anything you withheld. From there, you subtract non-refundable credits or refundable credits if you have any, and any taxes you paid during the year, either through withholding for paychecks or estimated taxes. And from there, you get your adjusted tax due if you owe any taxes, or you get your tax refund, which I hope most of us are getting. So below the line deduction, remember, line is AGI. Below the line deductions brings down your taxable income. And there are two types of below the line deductions. You have to choose between either the standard deduction or the itemized deduction. The standard amount is just basically the amount that the IRS gives as a standard to taxpayers based on their filing status. But if you had certain expenses during the year, the itemized deduction might be a better option for you. And basically what it is just a list of qualified expenses that can be deducted. And you should only use itemized deductions if it's greater than the standard deduction. And remember, itemized deductions are here because the IRS knows that it's a tax burden for certain taxpayers who incur certain expenses. Now, the standard deduction for 2021, if you're single, the standard deduction is $12,550. And single doesn't mean whether you have a boyfriend or girlfriend or not, it's your marital status. So if you were married December 31st at 11:59 p.m., you are considered married for tax purposes, and you would either file together, jointly, or separately. But I'm assuming most of us are single here, so this is your standard deduction for the year. As you can see, the amount is really big, right? It's $12,550. If anyone spent this much money in qualified expenses, then you should consider looking into the itemized deductions. And from here, let's see if we have any questions. Let's see. No questions here so far. Okay, so
I have a question.
At least in the Q&A, sorry. Go ahead, Steven.
So is there a benefit to getting married tax-wise? I know that's like is there a general rule? Because I know it all depends on the situation.
Yeah, there actually is, because depending on your income, if you recall from our previous presentation, our taxes are calculated based on brackets, right? If you're single, the bracket is more narrow. So like one bracket is, I think, 10%, and then it goes like 15 and then 20 and whatnot, and so on and so forth. So every bracket is more narrow. So the income range is more narrow. But if you're married, it widens. So let's say your spouse and you have unequal incomes, like you make a lot more or your spouse makes a lot more. If you combine those incomes together, you will benefit by being in a lower tax bracket. I hope that makes sense.
Got it. Thank you. So it is generally better to get married for tax.
Yes, and yeah, there's some credits and deductions that you can only take if you're married as well. I forget which ones, but there's some ones where you can only take them if you're married. For example, the unemployment compensation exclusion that I mentioned previously in California, since we're a community poverty state, if only one spouse, to my knowledge, if one spouse claims unemployment and the other spouse doesn't, because of the community poverty state, that one spouse's unemployment income is considered both of you guys' unemployment income. So each of you get an unemployment exclusion adjustment. And that amount is pretty big. I think it was like 13K or something like that. So each of you get 13K, even though only one spouse had the unemployment benefits. Does that make sense?
Cool.
Yeah, that's just like one of the few. There's plenty more. Okay, any other questions? If not, we'll move on. Itemized deductions, that's our focus today. And like I mentioned, the IRS knows it's a tax burden for people to own houses or have medical expenses or pay taxes. So these are a list of expenses that the IRS knows are a burden, and they want to help you out and give you a tax benefit by letting you claim these as a deduction if it exceeds your standard. So like I mentioned, medical and dental expenses are deductible. Taxes paid, this includes state and local income taxes or sales tax, so you pick one or the other, as well as real estate taxes, so this is property taxes if you own a home, and personal property taxes. Also, another expense is interest paid. So this includes investment interest, not the ones you make from like passive activities, so where you're not actively involved in activity. So if you invest in stocks and stuff like that, that's not considered, that's considered passive because you barely participate. So that's not deductible, but mortgage interest is deductible. So if you own a home and you finance it through a mortgage, your interest is deductible. Also gifts to charity, right? They don't want to penalize people who are giving back to people in need and those organizations in need. And also casualty and theft losses. If your house burned down or you were subject to some sort of financial hardship where it was out of your control, any expenditures you incur, deductible. And we'll go through these sections one by one, and it's actually on Form Schedule A, where you report it. It's part of Form 1040, which is, the federal individual tax return. So if you want to follow along and see what's coming up, you can click on the link that we'll share in the chat box and take a look at Schedule A. So the first section is medical and dental expenses. So it's like this on the Schedule A. And what can be itemized? Well, medical or dental expenses paid out of pocket that exceed 7.5% of AGI. So there it is again, AGI, guys. And what this one is that this is a floor, right? You have to spend at least 7.5% of your AGI in order to even think about deducting medical and dental expenses. These medical and dental expenses have to be paid by you and cannot be reimbursed by anyone else So it can't be reimbursed by your health spending account, your flexible spending account, or your employer. It has to be paid by you, and you suffer from the financial damage yourself. So as an example, let's say you had a total of $90 in medical and dental expenses that were paid by you. No one else paid you back for it. Your AGI is $1,000. So let's calculate what's the amount that I have to spend. 7.5% of $1,000 AGI is $75. So I have to have at least spent $75, which I did, and I have to deduct that from my total medical and dental expenses as well. So $90 minus 75 equals $15 that I can deduct on my tax return. So it's not a lot, but it's something, right? And keep in mind, right, this isn't the only itemized deduction there is. There's plenty more. And all of that, if it adds up more than your standard deduction, you should take the itemized. So what constitutes medical and dental expenses? Well, let's talk about the ones that aren't medical and dental expenses. This includes cosmetic surgery for purely cosmetic reasons. This can also apply for orthodontia, right? So if you want to straighten your teeth out with Invisalign or whatever, for purely cosmetic reasons, like there's no medical need for it, it's not deductible. Life insurance isn't deductible. Cost of diet food isn't deductible unless it's medically necessary. Illegal operations or drugs are not deductible. Imported drugs not approved by the FDA are not deductible. Non-prescription medicines other than insulin and funeral or cremation costs, not deductible. What is deductible includes, insurance premiums, which is interesting. If you go to acupuncture, chiropractor, eye doctor, physical therapist, psychiatrist, or podiatrist, that's deductible. That's pretty cool. With tobacco or nicotine, deductible. Surgery to improve your defective vision, so laser eye surgery, deductible. Medical aids, so eyeglasses, hearing aids, wheelchair, guide dogs, deductible. And in 2020, this is new, any PPE, so personal protective equipment to prevent the spread of coronavirus, deductible. So masks, hand sanitizer, that kind of stuff. And also, if you got to go to the hospital and got to ride an ambulance, deductible. Next section, taxes you paid. So what can be itemized? You're only allowed to itemize up to $10,000. And you have the option of either state and local income taxes or state and local sales tax and property taxes. So you got to pick between income taxes or sales taxes, and you add in your property taxes as well, only up to $10,000. And keep in mind that property taxes is only what you paid and not the amount assessed. If you're a homeowner or you know of a homeowner, you will probably be aware that property tax bills are given once, but it comes with two payment stubs. One is due in the current year and one is due in the next year. And that's usually because governments are run on a fiscal year, meaning that their year end isn't December 31st, their year end is June 30th usually. But keep in mind, right, individuals are cash basis, meaning you report your taxes on things that occurred in this year physically. If you're an accountant, you'll understand what I mean. But if you pay both of those both of those voucher stubs in the same year, then you can deduct them in that year. So if you paid last year's property tax and two portions of this year's property tax, you can deduct all three in the current year. But that's not a benefit now because you can only deduct up to $10,000, and property taxes are off the roof, probably more than $10,000 if you pay both of them. So just keep that in mind. Now let's talk about the option A of income taxes and option B of sales tax. So what are state and local income taxes? This includes things that are held from your paycheck. So what was taken out of your paycheck is considered paid income taxes, right? They took it out of your paycheck, but it's still income taxes. So you can deduct that. You can also deduct any taxes that were taken from your 1099, and also taxes you paid in your last year's tax return if you owed anything, and also any estimated taxes you prepaid during the So basically anything that's state or local in income taxes, you can deduct it. And also in California, right, we have that special line item on our W-2 called, or W-2 and paycheck called California SDI, which is state disability insurance. That's what we're contributing to. You know, if you ever get sick and you won't get paid through your job, you can file a claim with the California State Disability Insurance and you can get supplemental pay. That's deductible, the amount that you're contributing towards that SDI. And option B is to pick your sales tax. So whichever you think, right, you incur more of. Sales tax is what you pay throughout the year. You know, you get taxed on things that are not food. And this includes clothes, right, shoes. I think medicine, over-the-counter medicine is also taxable. Towels, I don't know, anything that has sales tax. You can either keep track of your receipts, of your actual expenses, or you can use a sales tax table that the IRS provides in the instructions on Schedule A, or they provided a sales tax deduction calculator. And what this is actually something really simple. It's just a calculator. They ask you a bunch of questions, kind of similar to TurboTax, right? So this year it's 2021. I'm single. I don't have any dependents. I didn't buy anything under a lease. I click next. I put in my AGI. So what this calculator does, and what happens when you don't actually do your keep track of your actual sales tax that you want to claim, it's based on your AGI and your local sales tax. So they'll estimate, oh, what is the average person spend in taxable items and calculate it that way. So my AGI, let's say, is $1,000. I don't have any non-taxable income. I lived in the same address all year long, and let's say my zip code is 94105, San Francisco. So they're asking all this information because they're pulling up like the local sales tax data and your AGI. And from there, they think you can deduct that much in sales taxes. So if you don't want to keep track of that, of your actual sales tax, you can use this calculator or you can use the table. Okay. And this is what it looks like on the form. So 5A is where you check the box if you're doing sales tax. If you're not doing sales tax, then you just put in your income taxes. And then real estate taxes are your property taxes, and personal property taxes are like things you own that are worth a lot of money that you have to pay taxes on. And then from there, in 5E, that's where they limit you, right? You add this all up, and if it's lower than $10,000, you put that amount, but otherwise you put 10,000 amount. So there's your $10,000 limit. Checkpoint, any questions? I have 5. Can you go over the formula for medical expense again? Sure. So the formula for medical is here. So basically, you have to, so number one, you have to spend at least 7.5% of your AGI. And next, you have to subtract that floor amount, 7.5% of AGI, from your total expenses in order to get your itemized medical dental expenses for the year, which kind of sucks, right? Okay. Should I be keeping all my receipts for itemized deductions? Highly, highly recommended, because you never know if you're going to get audited. Chances are of you getting audited pretty low, but you can never rule out that possibility. So if you're a person who likes taking risks, like, be my guest, but I don't recommend it. Okay. Number 3, where do you find state income taxes paid? W-2? Yes, it's on your W-2. It's on that bottom section. I don't want to show you my W-2, but there's a section that says state wages and then state income taxes. And also on the W-2, I think it's box 13. There's a section where it's like typed in CASDI. That's also part of income taxes. So it's smarter to pay property taxes annually and try to keep it at 10K. Yes and no. Yes, what you're saying is true, but no, because if you know how property taxes work, right? There's like 2 vouchers, one for this year and one for next year for that one property bill. But if you think about it, the next year, you're going to be paying the current year's first payment, and you already paid last year's second payment in the calendar year, right? So kind of nets each other out. So it's better just to do the regular way, like the natural way of paying property taxes. A thing is, before they changed this rule in, I think, 2017, 2018, you could deduct as much property taxes as you want on your tax return. But then after the tax reform, they limit it to only 10K. So that year, a lot of people, before the tax reform became effective, a lot of people paid 3 payments in 1 year so that they could deduct it all in that year. And also, in a sense, your question is, or what you're saying is correct, because let's say 1 year you think you're going to make a lot of money and you're going to have to pay a lot of taxes. So to plan that, to tax plan, right, you can pay more property taxes now, so you get a bigger itemized deduction and bring down your tax liability. So yes, it is smarter to pay if you think you're going to make more income that requires you to pay more taxes. But otherwise, if you don't have any like big things coming up, you just do the natural way of paying your taxes, property taxes. So like unemployed people that buy a lot of stuff and don't have income would choose to deduct the sales tax paid, trying to figure out what the scenario would be. I feel like if you're unemployed, maybe the standard deduction would be better for you. Well, if you're unemployed, you wouldn't have a lot of money that buy a lot of stuff and don't have income. This part doesn't really make sense. If you don't have income, how can you buy a lot of stuff? But I'm not going to be technical here.
Yeah, I'm just trying to figure out who would do that. Yeah.
I know, that's why a lot of people don't. A lot of people just take the income, but some people who do pay a lot, or
That's a good point.
a lot of people do pay a lot.
Maybe it's medical.
So let's say you're not employed, right? Yeah, medical expenses, right? Yeah, so if you do like actual sales tax, then yeah, maybe that would benefit. But if, let's say you don't want to keep track of it and you do a sales calculator, since it's based on AGI and you're unemployed, so your AGI would be pretty low. Actually, AGI would include unemployment benefits because it's federal. I guess you really depend on the person. You really have to calculate both and figure out which one would be the best. Okay. Any other questions? Okay, let me just hide this one. Okay, so let's go back to where we took off and go into interest paid. So interest paid, this mainly benefits homeowners because it targets mortgage and mortgage insurance premiums and investment properties. So it's mainly a benefit for homeowners who are financing their house through a mortgage. And interest on mortgage debt is deductible, as well as insurance premiums and loans on investment properties. And let's go through this definition, because I know not a lot of people here may know what this is. And but we're at that stage where we should at least be aware of what these things are. So let's take a look at some definitions. So the first thing is home mortgage interest and points. So home mortgage interest is interest paid on a mortgage to finance a home. And you hear this term a lot, right? So if you buy a house that's really expensive, right? They don't expect you to pay it all in one go. Like houses are $1 million nowadays. You can borrow money to slowly pay off that debt. And when you borrow money, there's usually interest involved. So you have to pay the lender principal, which is how much you borrow from them, along with interest. And usually these mortgage terms range from 15 to 30-year loan periods. And people who have cash on hand may choose to pay points. And these points are fees paid to lenders in exchange for a reduced interest rate. And mortgages are like 15 to 30 years, right? So it might be beneficial to that person, to the borrower, to pay more money now in exchange for a longer interest or a lower interest rate over the longer period. So that's things to consider if you're thinking of taking out a mortgage. At the end of the year, though, the lender will give you a Form 1098, which summarizes everything you paid during the year, including points, interest, and I think principal paid and how much you borrowed from them. Now, mortgage insurance premiums are premiums paid for private mortgage insurance. And it may either be optional or required by the lender to protect them should you ever fail to make the mortgage payments. So these are for high-risk borrowers. This also includes fees paid to Federal Housing Administration or FHA-backed lenders. So this again is to protect the borrower protect the lender should the borrower, fail to make mortgage payments. So it's insurance that the lender requires you to have. And again, this is summarized at the end of the year on Form 1098. The lenders have to give you this. If you decide to refinance your home, which basically means that you decide to pick a different lender in order to secure a lower interest rate, you should be expecting 2 Form 1098s, one from your old lender and one from your new lender. And like all the other deductions I mentioned so far, there's restriction and limits. So for home mortgage interest, if your loan was before 1987, there are limits that I'm not going to discuss because first of all, I don't know them. And second of all, I don't think any of us are even older than this, 1987. And so second limit is if your loan was made after 1987, but on and before 2017, your interest is only deductible on up to $1 million of debt. So nowadays we're taking out, well, this is not nowadays, but this is in 2017. You had $1 million of debt and interest that you could deduct. But after 2017, which is the tax reform, the most recent tax reform, interest is only deductible on up to $750,000 of debt. So it's lower than before. But nowadays in the Bay Area, homes are like $1 million. Most of us are like, if you decide to buy a home, your mortgage is going to be more than this. So in the Bay Area, you really will get shorted on interest deductions for your itemized deduction. And keep in mind, if your loan exceeds the fair market value of a home, there are limits that I'm not going to discuss because I don't know your financial situation and so on and so forth. In terms of mortgage insurance premiums, there's also limits that are based on income and how to allocate your insurance premium over the year. But I'm not going to discuss that because I don't know anything about it. And if you have interest on loans for investment property, you also need to fill out Form 4952 as well. Second to last section is gifts to charity. So like I mentioned, the IRS wants to not penalize people who contribute back to society through charitable donations. So there's been a lot of rules, especially with COVID. They want to encourage people to donate more. So there are new rules and a lot of temporary rules, but the general rule is that cash and property given to qualified charitable organizations that you can deduct cash and property given to qualified charitable organizations that are less than 30 to 60% of AGI. So this is different from the medical and dental expenses where we had to have a floor. This one is kind of a ceiling, right? You have to, or there's like a limit to how much you can deduct based on your AGI. Instead of meeting a minimum, you have to spend less than a certain amount. So the deduction is limited to 60% of AGI if you donate cash or 30% of AGI for capital property. But keep in mind that if you donated more than 60% of AGI for cash or 30% of AGI for capital property, you can carry the extra amount to the next year and then next year and then next year indefinitely. So they really want to limit, but also not penalize taxpayers who donate. And let's run through a little example. So I have the percentages up here if you want to reference them, right? So let's say you donated cash of $1,000 and your AGI is $1,000. You are a very, very virtuous person giving almost all your money away to charity. we know that 60% of your AGI, you can only donate less than 60% of your AGI. So 60% of your AGI is $600. You donated $1,000. So $1,000 minus $600 means $400 aren't deductible this year. That makes $600 the amount that I can donate this year, but $400 I can carry forward to the next year and the next year after that. And also, you can never donate more than 100% of your AGI. Keep that in mind. They want to reward people who donate, but they don't want people to abuse this benefit. And the last section that I'm going to discuss are casualty and theft losses. So this is for people who are financially affected by federally declared disasters. Before tax reform changed a lot of things, but before tax reform, this could be anything really. It didn't have to be federally declared disasters. Like if you were subject to wire fraud or home theft, that kind of stuff could be claimed. But after tax reform, to my knowledge, you can only deduct things that are related to federally declared disasters. And the requirements are that for each disaster, you have to have a loss of at least $100. And all of these losses during the year has to be more than 10% of your AGI. So this is similar to the medical and dental expenses where you have to have a minimum amount to be spent. And you also have to complete Form 4684. So let's say last year, there were a lot of federally declared disasters. There were hurricanes, there were wildfires in the North and South California. Let's say you had a home in North and South California. If each of these were burned down in those federally declared disasters, and you suffered from more than $100 in loss in both homes, and all of it is more than your 10% of AGI, that's deductible. But keep in mind that your loss cannot be reimbursed, like this $100 or the total amount cannot be reimbursed by insurance or any other, benefit welfare program kind of thing. So this is similar to medical and dental expenses where the loss has to be incurred by you and could not be reimbursed by anyone else. And before we go to Q&A, so that's the last thing. There's also another section on Schedule A, if anyone's looking at it, for others. Other itemized deductions, there's like a list, but I don't think they're really relevant to us unless you gamble. Then there's one line where you can itemize your gambling losses up to the amount of gambling earnings. But other than that, I don't think it applies to most of us here. So before we move on to Q&A, I just have some takeaways I want you to keep in mind. Everyone's situation is different, and I only covered like a high level overview for the purpose of providing exposure to this topic of itemized deductions. If you're considering doing itemized deductions, I would suggest you talk to an accountant or other people who do take the itemized deductions, or if you're planning on buying a home and you want to itemize, talk to people who have already purchased homes. And if you have medical expenses that you think you might have coming up, look into your health insurance plans and see if you meet like the out-of-pocket maximum, because that's a better benefit than taking the itemized deductions. But also consider your financial ability to incur the costs. And always read your forms. If you don't know what's going on, always go to a tax professional for itemizing. If you plan to buy a house, you must most likely benefit from itemizing deductions. So keep in mind everything I just said, right? About mortgage interest being limited if your loan is over $750,000. How property taxes and income taxes can only be deductible up to $10,000. What else? Yeah, for home, right? Those are the two main ones. Keep good records. And like I said, if you have any major medical expenses coming up, consider doing them in the same year so that you can claim that deduction, but also really look into the insurance instead and see if you meet the out-of-pocket maximum so you can plan your medical needs around that. Okay, and that's it for my presentation. Let's see if there's any questions. I don't think there's any new ones. Yeah, I don't see any new ones in the Q&A.
Hey, for the you said
Mhm.
the maximum, or like you can't donate more than 100% of your AGI.
Yep.
Does that mean like, well, you can, but you can't deduct more than 100% of your AGI?
Yeah, that's what I meant. Like you can do it,
Right.
but you can't deduct it in the current year.
Interesting. But you can carry it forward forever, right? The value of
Yeah,
that.
depend. So like your AGI, you might have to look into that because this year there's actually a new rule where it says I think that you can do that. But yeah, look into it. But yeah, you can carry forward anything you can deduct for like future years.
Interesting.
Stumping me.
No, I just like to like try to figure out why certain like rules are in place. You know what I mean? Like you said, to not abuse it. And then I like to think of like the fringe cases where it's like, what do I have like a huge donation and then I'm not going to make anything for the next 10 years?
Yeah, so you lose it basically.
I don't know where I'm going with that. Anyways. Let's see. Are Social Security payments considered taxable income or no?
Social Security benefits, yes, they are. They are.
What? Okay, interesting.
But. But keep in mind, like you're talking about like retirement or SSI, right?
Yes.
Yes. So if there's income thresholds, if you make over a certain amount, a certain percent of it is taxable. If you make under a certain amount, none of it is taxable. So you want to look at those income limitations.
That's so interesting because aren't those taxes that you already paid?
Yeah.
Cool.
Yeah, if you look on here, I'll drag it over. Wait, can you see this?
I see the tax formula.
Can you see this?
No.
Oh, okay. Let's see what happens when I do this. Can you see it now?
Yeah.
Okay, cool. Wow, what a glitch. Anyways, right here. 6A.
Social Security benefits.
Oh, I see. Nice.
Any other questions? Otherwise, we're going to hop into a quiz.
Well, give me a quiz. I'm ready.
Okay. It's only 2-question quiz. And, it's not to like penalize you or anything. It's just something to fill up the time if there's no other questions. So go ahead. Let me open the.
Oh, this is back on Menti.
Yeah, Menti. But you guys can it's a new link, or you can type in this code.
New.
Can you paste the link in the chat?
Okay. So what is the maximum amount that you can deduct in taxes? That you can itemize in taxes. Oh, let me start the countdown.
You think it's this one?
Results are hidden, guys. I'm not going to show them till the end because otherwise you'll cheat.
That's medical.
This is taxes, guys.
Yeah.
Your total taxes?
I think so.
Yeah.
Okay.
The maximum amount that you can deduct. So your selections are $10,000, $750,000, or only up to 7.5% of your AGI. 30 seconds. I wonder if there's a way to make this timer shorter. But I only have 5. I'm missing 1 person. Maybe somebody dropped.
Oh no, it's me and Steven are sharing the computer.
Okay. In that case, everyone's here. Let's see. Wow, the answers are split.
Well, it is not that one, bro.
The correct answer is $10,000.
Oh, really?
So
Wait,
this is
really?
kind of tricky. Yeah, so this is kind of tricky. So
You
this
got lucky, bro.
$750,000 is the limit on interest debt, right? So if you have a mortgage, if your mortgage is bigger than this amount, you're limited on your interest deduction. This 7.5% of AGI is, I think, your medical.
Wait, but I thought
what do you mean?
individual wasn't a standardized deduction 12,500. How come itemized? Wait, itemized is less than that?
Yeah. So remember itemized deductions, there are like a bunch of sections, right? In taxes, in the taxes section, you can only have $10,000 in taxes you can itemize.
Oh, taxes.
Girl, the wording, following.
Oh, really? Itemize in taxes, y'all.
True, true, true.
Itemized.
Nah, you good. They were paying attention.
No.
You're good. They were paying
No.
attention. I got it.
Complaint.
See, Conan got the right answer.
The dude, 33% chance of getting the right answer. Somebody got
Okay. The next one. If I donated more than I can deduct on my Schedule A, I get a certificate of appreciation from the IRS. Remember, they want to make sure that people who donate to charities aren't penalized. I can claim a refundable credit. Remember, credits can lower your taxes that you owe to the IRS, or that I can carry forward the extra amount to next year and next year and next year, indefinitely. All right, starting countdown, or until I get everyone's results.
So easy.
I like how I did it this time where I hid the results. Otherwise, everyone's going to click the highest answer.
How did you know?
Because I do that. Okay, one more person. All right, we got everyone. Let's take a look. Wow, everyone got it right, even though I tried to trick you guys. But yes, you can carry forward the extra amount year after year after year. Cool. Everyone paid attention for this last section, because I think this probably applies to most of us more than anything else. Oh, I forgot to mention, for charitable deductions in this year and last year, I think $300 you can deduct on your tax return without having to itemize. So keep that in mind. I think you can claim it on schedule or on the front page, your 1040, right here. Yeah, 12B. So if you take the standard deduction, you can donate a certain amount of your charity donations. So it's too late for last year. It's too late for this year to donate. But if you did, you can claim it on your standard deduction, which is kind of nice because they want to encourage people to donate. Can look at above the line deduction. So yeah, unemployment compensation is here. Here's your gambling income that you have to claim. So if you gamble and you make money, if you don't itemize, you lose out. But if you itemize, you can deduct your losses.
What is jury duty pay?
Yeah, when you get paid to go to jury duty.
Oh.
Like if you don't work, right? Or like you'd rather get the jury duty pay than like your minimum wage or something like that.
Right.
Yeah, the
I don't know how much
actually,
is it.
the city actually has a new program that's increasing jury duty pay, by the way.
Oh, how much is it?
I don't have the details.
But by law, employers have to give their employees paid time off to go to jury duty, right?
That sounds accurate, but I'm sure.
Or is that to vote?
Yeah.
Maybe it's to vote. Yeah, and I can't emphasize enough, how important it is to bring down your AGI. So these are all the things that, well, part one is things that bring up your AGI. But part 2 is what brings down your AGI. Part 2. Right here. So if you're an educator and you made expenses out of pocket, not reimbursed by anyone else, bam. Health savings account deduction, bam. If you're part of the armed forces and you got to move, bam. If you're self-employed, all this stuff. IRA deduction, and only for traditional IRA, not for Roth IRA. If you have student loan interest, bam.
Oh,
They reserve this line for future use.
wait, what? Oh, wait.
I mean, they're going to add something eventually down the road.
Oh, I was like, I save money for the future.
That's why it's grayed out. Yeah, I don't know what this is. There's an adjustment to jury duty pay. Wow.
Olympic
Wow. I never even seen that.
reforestation.
Let's see.
I don't know what the heck everything else is. But yeah, bring down your AGI, guys. Okay, that's my takeaway. All right, closing statement. Well, I hope everyone learned something, even though it's just a little bit. And if the more presentations and the more we talk about this, the more knowledgeable we come about this. Maybe like this first presentation, you guys are like, what the heck is going on? I don't know what's going on. What the heck is that saying? Why am I sitting here doing a 1-hour lecture? But the more you're exposed to this stuff, the more you'll be like, oh, I know what she's talking about. Oh, I know about the charitable deductions, stuff like that. Oh, I know about mortgage interest and what points are. You know, when we talk about it, the more we know and understand, or at least be aware of what these things are.
Thank you, Anna, for leading us through this discussion, this review of itemized deductions. Like Anna said, you may not retain every single thing that was covered today, but at least we know the foundation now. So when we need to, we know when to start itemizing and what type of deductions are possible. And for people who outsource their tax filing to accountants, this is a way to know what's going on, even if someone else is filing for you. Like Anna mentioned, there's so many details and deductions that an accountant who's filing taxes for hundreds of other people may accidentally forget something and something might slip through the cracks. So having this basic understanding allows us to keep them accountable and make sure we're truly minimizing all of our, I guess, tax burden. The last day to file your taxes is April 15th. So if you're considering itemizing next year, remember to start tracking your expenses and saving your receipts. Thank you everyone for attending, and we're going to post this recording online for all the people who couldn't make it today. And lastly, just to give an overview of our next few events, Jenny has kindly led our volunteering. So she found us a volunteering opportunity at St. Anthony's on April 9th from 1 to 4. Limited spots, so first come, first serve. We're 50% signed up. So if you're interested, let me know and then I can tell you the details. So that's in April. And then in May, we're planning another event, hiking/cleanup. And then Nat and Hari are going to review, or they're going to lead a session on moving out. So if you're considering moving out, what to consider and stuff like that. And in June, we're going to do a beach and bonfire day. Hopefully the bonfire part actually happens this time. And then also in June, Stephen's going to lead a discussion on the recall election for our district attorney, Chesa Bodine. And there are a few more events in the latter half of the year, but I will save that for later. So yeah, thank you everyone for attending.